You've probably heard someone say they're underwater on their mortgage, right? It's a phrase that gets thrown around a lot, especially when the economy gets shaky. But what does it actually mean to be financially submerged? Well, we're going to get into it. Because honestly, understanding this one concept is the key to understanding the massive boom and bust cycles that shape our entire economy, and maybe even your own financial life.
So here's the game plan. We'll kick things off with a simple definition. What does underwater really mean? Then we'll look at why it's a completely different kind of problem for a homeowner versus, say, a stock trader. From there, we'll dive deep into the 2008 meltdown as our big case study and see the huge economic and mental toll it took. And finally, we'll look ahead at the new risks on the horizon that could spark the next crisis.
All right, let's start at the beginning. We're going to strip away all the financial jargon and get right to the core of this whole thing, a little concept called negative equity. So you hear that phrase all the time, right? I'm underwater. But you know what? It's not just some casual expression. It's a very real, very precise financial state. And it's a state that has impacted millions and millions of lives. So the fancy term for this is negative equity. And all it really means is that the thing you own, let's say it's your house, is now worth less on the market than the loan you took out to buy it. Your equity, which is the part of the house you actually own, has completely vanished. In fact, it's less than zero. It really all boils down to this one simple and kind of brutal formula. The second the value of your asset dips below what you owe on it, boom, you are officially underwater. And that gap, no matter how small it seems at first, is where all the trouble begins. Okay, so this is where it gets really interesting. You might think being underwater is the same no matter what, but nope. It is a completely different world of pain when it's your house versus, say, an investment in the stock market. Just look at the difference here. When your house is underwater, it's a trap, a relentless, ongoing debt trap. If you want to sell, you literally have to bring a giant check to the bank just to get out. It paralyzes you. You can't move for a better job. You're stuck. But in the market, an underwater stock option is a whole other story. Yeah, you lose money, you lose what you paid for the option, and that's it. The position just expires. It's painful for sure, but it's a clean break. It's over. So what's the one thing that connects these two worlds? What's the secret ingredient that makes them both so dangerous? It's one word: leverage. Using borrowed money, whether it's a mortgage with a tiny down payment or trading stocks on margin, is the common catalyst. See, leverage is like rocket fuel for your gains, but it's also a massive accelerant for your losses. It just torches your equity cushion and shoves you underwater at a terrifying speed. And if you want to see what happens when this goes from being a personal problem to a full-blown global nightmare, you don't have to look any further than the 2008 financial crisis. This is where we all saw, in real time, what happens when a problem for millions of individual homeowners becomes a catastrophe for the entire world. So, how did we get there? Well, it wasn't an overnight thing. The path to disaster was paved over years. It really started in the early 2000s with a huge boom in subprime lending, basically giving mortgages to just about anyone with really lax standards. Then, all those risky mortgages got bundled up and sold as complex investments to people all over the world. And then, in 2007, the music stopped. The housing bubble burst, home values cratered, and the result was a tidal wave of defaults and foreclosures. And this is where things just went into a death spiral. It created this vicious feedback loop. Home values started to fall, which pushed more and more owners underwater. So some of them just walked away, what's called a strategic default. That flooded the market with foreclosed homes. All that extra supply, of course, drove home prices down even further, which in turn pushed even more homeowners underwater. It was the perfect economic storm.
But the damage here wasn't just about dollars and cents on a spreadsheet. We really have to talk about the hidden costs of all this debt overhang on both the economy and, really, on the human mind. I mean, think about the ripple effect on the whole economy. First, people who are underwater, they just stop spending money on anything that isn't essential. Then you have people who are literally trapped in their homes. They can't move to a different city for a better job, which keeps unemployment high. The banks, they get spooked and stop lending money to anyone, creating a credit crunch. And you could see the physical scars too, entire neighborhoods hollowed out by vacant, foreclosed houses. But honestly, to really get why this was so devastating, you have to look past the economics and into our own brains. There's this powerful idea from behavioral economics called loss aversion. And it basically says that for us humans, the psychological sting of losing $1,000 feels way, way worse than the pleasure of gaining $1,000.
And this idea of loss aversion, it creates these mental traps that are so hard to escape. First, you get people just clinging to a house they can't afford, praying the market will come back and save them. Then you have the flip side. People who owe, say, 300 grand on a house that's now worth 180, and it becomes the most rational choice to just mail the keys back to the bank and walk away. And of course, you can't forget the sheer emotional weight of it all. The stigma, the stress, it makes clear financial thinking almost impossible.
Okay, so it's easy to think of 2008 as ancient history, right? Problem solved. But the risk of being underwater is absolutely not gone. In fact, there are brand new threats brewing on the horizon right now that could create the next wave.
Just think about a few of them. What about climate risk? What happens when huge areas of coastal property become basically uninsurable, creating stranded assets nobody wants? And then there's commercial real estate. The remote work revolution is emptying out office buildings, putting billions in loans at risk. And of course, there's just good old-fashioned interest rate volatility. A few rapid rate hikes can slash asset values across the board and catch anyone with too much debt completely off guard. So all of this really leads to one big, kind of scary question. After everything we learned, or at least thought we learned from 2008, we put a lot of new rules in place. But as we face these totally new kinds of risks, you have to ask, did we actually build a seawall strong enough to hold back the next wave? Or did we just build another sandcastle, waiting for the tide to come in?